Hello, and thank you for joining us on the Optimal Wealth Podcast, where we discuss creating passive income through real estate. Our mission is to help educate investors on how to grow wealth and invest passively. My name is Jared Alexander, and I am a passive investor, currently in 6 syndications as a limited partner. I am also the founder of Optimal Equity Group, which is a real estate investment firm that was created primarily to help educate the passive investor. We do that in a couple of different ways. One is we provide education to help give you the confidence to get into the passive investing space. And two, each episode we will interview amazing guests that explore the strategies, insights, and secrets used by successful investors. Whether you're a seasoned investor or just starting out on your real estate journey, this podcast is designed to help give you the confidence and knowledge you need to make informed and profitable decisions. All right, welcome to another episode of the Optimal Wealth Podcast. I am Jared Alexander, and I'm super excited for the guest we have on the show today. He is one of the founders of the Left Field Investors and the host of the Passive Investing from Left Field podcast. He is also a former financial advisor and now concentrates on investing in real assets that produce cash flow and is committed to sharing his knowledge with others who are interested in learning a different way to grow wealth. Jim Pfeifer, welcome to the show.
Thanks for having me, Jared. It's a pleasure to be here.
Absolutely. Well, just before we get into your background, I just wanted to take a moment to thank you personally for all that you do. I can't tell you the countless hours that I've listened to your podcast, just to help educate myself on things, just to be able to make informed decisions, before I wire my money over to these operators, right? Yeah. So I just wanted to take a minute to thank you, because it's pretty cool to have you on the show here today, and just how, without you really knowing it, how much of an influence you've had in just my investing journey, and just having the resources on your podcast and then the community that you built. So yeah, thank you for that.
Well, thanks. That's very nice to say. It is a community, and we all learn from each other. So, everything I share is things I've learned from others in my community and elsewhere. And this is a team sport. So happy to help. And, I'm really excited to be on this show, and glad that you're, paying it forward and helping others as well.
Yeah, absolutely. Well, with that, let's go ahead, because I know we're definitely going to touch on community a little further here, but let's go into your background. And if you could just share how your journey and just how you landed into the passive investing space.
Yeah, I think this is kind of career number 5 for me. I did a bunch of different things. Right out of college, I was worked in finance. I was an underwriter for a reinsurance company, and then when I quit that, I became a high school teacher for a while, teaching finance and accounting. And then I became a financial advisor. And all 3 of those jobs, the focus really was education. I was, at each stop, I would find ways to educate and help others learn, because that interested me. And that's a great way to learn yourself. But as I was a financial advisor, I also got a little bit into real estate, because we bought a house we had a house, and we built a house in 2008, couldn't sell our old house because the market was just terrible. So turned out to be an accidental landlord, rented a property, and really didn't like it at all, because I was managing the property, and I just wasn't really into it. But at the same time, I was becoming a financial advisor. I thought I knew everything about finance and stocks and mutual funds, and that's all there was to it. And as they teach you, they kind of start over and say, okay, we're going to pretend you don't know anything about money. And they were educating me. I was looking at the real estate and realizing that all the stuff they were educating me about how money works, it really had a better application in real estate than it did in the stock market and things like that. And I began to recognize that real estate was investing, right? You're putting money into an asset, and you have a current benefit in the form of cash flow, and then you maybe have appreciation on the back end. So that's investing, right? And I found that the stock market, mutual funds, all the products that I was actually selling as a financial advisor, that's more speculation, right? You put money into something, there's no current benefit, and you just hold on to it until you can find someone else to sell it to for more. So you're really just hoping that you can find someone else to buy it for more later. So as I slowly figured out that, that was what real estate was, where I wanted to be, over a number of years, it took me to kind of come to the realization. I started buying more real estate, single family homes, small multifamilies. Eventually I stopped, I quit being a financial advisor because, I prided myself in investing in the same things as my clients. And I couldn't do that anymore because I was putting all my money into real estate. And, financial advisors, they don't avoid real estate because they're trying to be sneaky or anything. There's two reasons why they don't recommend real estate to you. One is they're not licensed for it, so they can't advise on it. The other is they don't make any money on real estate. So you can't blame them for not putting you in investments where they don't make money, right? They got to feed their families too. So eventually I decided to become, full-time into real estate. And as I was doing that, I realized I was not a good asset manager. I had a bunch of single family homes, I had some multifamily, including a 22 unit, and they just weren't cash flowing. They never cash flowed. So that didn't really fit into with my strategy. And I finally found passive real estate syndications. And I realized I could hire an asset manager who did this full-time. That's their full-time job, and that they would do a better job at it than I had. Now, I was successful as an active investor, but only because the market rescued me. The prices just kept going up, up, up. And so, we sold all of our properties and made quite a bit of money, and then went full-time into passive investing. And that's when Left Field Investors started. It's a pandemic baby. In the March of 2020, I tried to put together kind of just a 12-person dinner club to find people to talk about passive investing. Our first meeting was March 18th, so it never happened because that's when Ohio closed down for the pandemic. And so we went online, and this little 12-person group grew. I tried really hard to keep it small because I was thinking it was a mastermind. So at the end of the first year, we had 50 people, and we just did online meetings. And now, we've grown into a business with, over 2,000 members. And, our mission of Left Field Investors is to provide education, a network, and deal flow to LP investors. So that's my long drawn out story of how I got to where I am.
Well, yeah, thanks for sharing that. Just a ton to unpack there. All right. But I do want to go back, and when you touched on, how we grow up, right? I mean, we grow up with just the mindset of, graduate college, get a job, work for 40 years, put all your money into that 401k, and hopefully you have enough to retire at the end and then enjoy it for the time left that you have left here on this earth, right? Yep. And I'm curious, being that you're a financial advisor, so somebody just kind of getting started out in this space is, and just learning to just in the education process. Do you recommend like they join like a group like Left Field Investing just to start out, or should they have, say like a financial advisor, maybe a fiduciary, right? That's someone that has their interest, at hand, of walking them through that, or does the fiduciary still push, the stock market, self-directed, IRAs, things like that?
Well, first of all, I just want to make sure everyone understands I am not a financial advisor. I'm just a regular guy that's had some experiences, and I'm happy to share with you.
Former financial advisor.
Yeah,
yes.
Former financial advisor. Exactly.
Yeah,
so I want to touch first on the fiduciary thing, because that always bothered me, that people think that, as long as the financial advisor is a fiduciary, right, where they've taken some licenses that make them a fiduciary, it's typically the Series 7 or something like that. If you're a fiduciary, that doesn't mean you're not going to defraud, steal, or do something bad. It just means that you've had some training that says you shouldn't. Well, a non-fiduciary has the same thing. So when I look for a financial advisor, I don't really care about the fiduciary part. What I care about is finding someone that I know, like, and trust, who's going to put, as you said, put my best interests forward. Now, they can be required to do it by law or not required to do it by law. But what I want is someone who's going to do it because it's the right thing to do. Right. And so I think people stress the fiduciary just a little bit too much. Again, that's just a personal little opinion I have. But, would I, if I was just starting out, the thing is, if you're going to be a passive investor in a syndicate, in LP syndications, right, a limited partner, and you're just starting out, you need capital. That's the first thing. It's not like we go on to bigger pockets and you want to get into real estate and be an active investor and you can do wholesaling or, the Burr method where you don't need as much capital. For this limited partner investing, you need capital. So that's kind of part number one. But would I join a community? Absolutely. Even if you didn't have the capital yet, real estate is super powerful. And I would recommend people focus on real estate before they focus on the stock market and those things. And that's just from what I've learned. The returns are better. The taxes, you don't pay near as much in tax. I mean, there's all kinds of reasons we can talk about why real estate excels. But that doesn't mean you don't need a financial advisor. I have one for many things. I have one because I do have some old IRAs that my advisor manages. I like the whole life insurance and my advisor helps manage those. But my advisor is also a real estate investor. So I know that he is going to take my real estate investments and incorporate them in the overall evaluation of my financial portfolio. The wealth of our family is what he's managing. So I don't use them, to go buy stocks and mutual funds and things like that, but he helps me manage my finances. And that's what I think a financial advisor should do. So the answer to your question is, yeah, engage with a financial advisor, but find someone like and trust. And where do you find that? Generally from people that you know in your community. Same thing. I would find a community. If you're interested in syndications, find something like Left Field Investors. It doesn't have to be Left Field Investors. Find a community where the culture of the community fits your personality. And that's the most important thing. Find a place where you're comfortable so you can talk about these things with other people, learn from other people. And that's the best way to kind of increase your financial acumen.
Yeah, thanks for that clarification. Because I you do hear the fiduciary and you automatically think, okay, they have your best interest at hand, but they're just really getting a certificate, or taking another test, right? And so, yeah, no, that's good clarification there. And so, okay, so you got, you step into this world of passive investing. Well, what did that process look like after, okay, hey, we did, you made some money from the active, real estate investments that you had, the single families. I think you said you had some multifamilies as well. How did you go about finding that first sponsor? What was the due diligence? What did that process look like?
Well, I was terrible at it at first. I went through kind of a 3-stage process to get to where I am now as far as finding sponsors. So the first thing I did was I hadn't really decided to be a passive investor yet. So I went, the real estate guys have a syndication seminar. Mm-hmm. And so I went to that thinking maybe I would become an operator, a syndicator, and have my own deals. And I was there for about 5 minutes when I heard about LPs and limited partners and how passive they are. And I thought, that's for me, because I was recognizing that I wasn't doing very well at the active stuff. Right. And so I assumed, and first of all, I had a old IRA that I made self-directed. So it was kind of burning a hole in my pocket. And I said, well, look at all these operators and syndicators that are here at this seminar. They must all be fantastic because they're here. Right. I didn't understand how the circuit worked. Right. Anyone can show up to these. Anyone can pay money and be there. But I thought, well, they must all be endorsed. It must be great. So I just started walking around the room saying, hey, I got money. Who wants it? And that is a really bad way to find operators. Right. So Some of those deals I invested in are terrible. Some are great, but it was just blind luck or the opposite of luck. Right. So that's a terrible way to go to a seminar and just assume that everybody's great and start throwing them money. So I realized that after I got back home from the seminar, and I decided I got to find a different way. So I started listening to podcasts, and I listened to a ton of podcasts by different operators. And then I would call them up and talk to them for 30 minutes and ask them a bunch of questions. And then I would have to decide whether I'm going to wire them $50,000 or not for their deal. Right. Well, okay. So I've heard them on a podcast, and I don't know if they're a great marketer or they're a great operator, right? I just heard them on the podcast. Then I talked to them for 30 minutes. Again, I still don't know if they're good or not. But I had to make that decision to wire them and start investing. And so that was much better than my first approach, but it still wasn't great because you're still not finding out are these guys great, good, bad? Who knows? And even if you ask for referrals, right, they're going to give you people that liked them, right, or had good experiences. They're not going to give you the bad referrals. So then slowly I came to the realization that this is what the community was built for, right? I have a community of people that I know, like, and trust. So right now, the way I find new operators is I won't invest with somebody that I don't know unless they are referred to me by somebody in my community who I know, like, and trust, who is invested with that operator, right? And it doesn't mean they've invested with them and a deal go full cycle and everything's all, sunshiny and roses. It means they've invested with them so that, they sent the wire, it was received. They've gotten reports. Maybe they've gotten some distributions. They've had a good experience. Because I still do all the same due diligence, ask the questions, make the phone call, talk to the operator, but I'm starting 100 steps ahead, right? Because someone I know, like, and trust has already done the vetting. And that doesn't mean I don't do it, but it means that at least they're legit and the process is working. So that's kind of how I do it now. Is I work with my community, and when I find a new operator, if I find somebody that is invested with them, I talk to them, I get a recommendation, and then I go through all my due diligence. And it doesn't always work, right? Especially, one of the things people always say is when you're looking for an operator, make sure they're experienced, make sure that they have a good track record. Well, we have operators that we've dealt with that, had 6-7 years of just great track record, 30 deals, all were just sunshine, just great, right? But that's the same thing I had as an active investor. They were just riding the market, perhaps. And so it's very difficult now to look back and say, okay, what were the mistakes I've made on some of those operators? Because some of them just failed because everything was going up. So you really have to be careful. And I think getting through this difficult time, uncertain economic times, when we look back on it, we'll really be able to say, okay, if an operator made it through this, they're at least doing something right. And that will be another way to help us evaluate operators.
And it just reminded me, because when you talked about referrals, right? Like I'm getting into this space, and actually, before I even forget to mention this, is Jim has a master class that they actually walk through the whole, from just starting to, vet an operator to the end, from signing the PPM and wiring your money. So, if you want, check that out. I think it's a free resource on your website.
It is.
Yeah. And so that was, I know I went through that, and it was very helpful to me. But, as far as just finding an operator, I was the same way with you, Jim. Maybe not at first starting out, I didn't go around the room, just start handing people my money. But, but I had a friend that was in this space, and, I didn't even know what a syndication was, probably
Right.
3 years ago. Right. Nobody talks about it. It's just kind of going back to the 401k, put your money in the stock market, mutual funds, bonds, things like that. And, hopefully they make money. Right. And so when I started getting in this world of syndication, and started seeing the returns and the tax benefits, and just, as an investor, that's what I'm looking for, right? And I like tangible assets. I like something I can drive by, I can see it, check on the operator to make sure, especially if it's in my backyard, if they're doing what they say they're doing. But whenever I first made that first step, I got a referral. I had a conversation, 30 minutes to an hour with the guy. I actually went on, I think this was even before I knew about left field investing, is I just printed it. What do you ask a syndicator or operator on Google, right?
Yeah.
They give you 20 or 30 questions and go on there. And actually, by the way, I know left field has one on their website as well. And there's probably 50 or 60 questions, and just you can do a checklist. But I'll tell you, a good operator is really going to go through probably half, if not more, of those just in an initial conversation, right? They're probably going to answer a lot of them, but it's good to just kind of have a reference there. But I make that first investment, and then the way I've learned, and we always talk about, well, what's your due diligence starting out? But I made that first investment, right? And then I started learning as a result of my experience with seeing the communication, seeing the distributions, how that works. Like you said, these operators, I'm in a few deals in these 2021, 2022 deals where just a lot of folks were getting bridge loans, and that was the thing. So that, in hindsight, it's like, okay, moving forward, I'm going to pay a lot more attention to the debt and how that's structured, right? And it's just something you don't even think about until until we're going through the experiences and they stop distributions, right? And you're like,
Yeah.
okay, hey, let me pay attention to this now. So yeah, I think the referrals is big. And that's, again, going back to the community at left field. That's what's huge is you can go on there, see about, people that have invested in different operators, what their experiences are. And people are really open and happy to just share and help you through that process. So no, that's awesome, Jim. And so I want to, shift into, okay, so, we go through the due diligence, we invest in decide to invest in an operator we know, like, and trust. So let's talk about some advantages of why syndications, right? Primarily multifamily, is, I know, where you're really heavy in, and as am I. So let's talk about the tax strategies first. So I know your CPA does what's called a lazy 1031, right?
Yeah.
Could you touch on that for us?
Yeah. So, the lazy 1031 is something I didn't really know about until when I was an active investor. We sold almost all of our properties in one calendar year. And so I went and had a meeting with my CPA and I said, look, I'm going to have a bunch of capital gains. All these properties went way up. No thanks to my management, but made some money. Yeah, what do I do? And he said, well, first he said, Jim, sometimes when you make a bunch of money, you got to suck it up and pay the tax. And I didn't really like that answer. And then he said, but the other thing you could do is a lazy 1031. And basically what that is using the depreciation of a new investment to offset the capital gain. So how the lazy 1031 works is it's lazy because it doesn't have all the same requirements of the 1031. But when you invest in a new syndication, multifamily or whatever, you're going to get some paper loss in the form of depreciation. Now, we had bonus depreciation, which is decreasing, right? It was 100%. Now it's 80%. Now it's 60. We won't get into the weeds of all of that, but you get this depreciation and it can offset gains. So as long as when you sell an asset, and it's got to be real estate related, but if you sell an asset and in the same year you invest in a new asset and you get loss from that new asset, that can offset the gain that you had on the old asset at the sale, right? So what I did was I took the proceeds from all the sales I made and I started investing in real estate syndications that I knew would have a pretty good, depreciation benefit. And so all that loss that I incurred that year offset all of the gains. Now, there are some drawbacks. It's not an exact science, right? Because you don't know when you invest in a deal exactly how much depreciation you're going to get. There's some where I've gotten 20% of my investment is depreciation, and there's others where I've gotten 110% of my investment is depreciation. So you're not going to be able to go dollar for dollar, right? But as you start investing in more and more real estate syndications, right? Let's say you don't have any syndications and you just start out with the first one, right? And you invest $100,000. And let's say you get $30,000 of loss, so 30%, right? So now you have $30,000 of loss, but you don't have any gains. So let's say you get maybe you get 5% pref or something. And so now you're collecting $5,000 every year. Well, you don't have to pay tax on that because you have this bucket of $30,000 of loss that will take care of that gain. So, for the first 6 years, you're not going to pay any tax on any of your distributions because you have this loss that you're offsetting. So the lazy 1031 strategy is every time an asset sells, make sure you invest again in a new one. That's kind of the golden hamster wheel, right? So you can effectively offset your taxes and never pay tax legally, of course, because every time that you sell an asset or an asset is sold, that gain is wiped away by the loss that you've incurred through investing in new deals.
So say you got that $50,000 investment, or say where we used 100,000 in that example, right? And so you get a $30,000 loss year one, right? 30%, which, actually those are pretty accurate numbers, at least when it was maybe 100% bonus depreciation. I think on a 50,000, I got like a $30,000 loss. So, I get say $5,000 a year. So I can take that against all my cash flow, right, throughout the hold period. Now, how does that work? Okay, so say year 5, that deal sells, right? I double my money like the projections of like they're projecting with the business plan, and I still have some losses left over. Do you take those losses and apply them to those gains as well? Or is it just the cash flow throughout
No,
the
you
whole?
can, the losses. So if you've invested just in one deal, you're not really grow. You want to grow the losses by investing in multiple deals, because that loss just builds up and it's used whenever you can use it, and it carries over to the next year forever.
Right.
So typically what happens when people first get into this, they invest in a couple of deals, 2, 3, 4 deals, whatever, and they have all this loss that they accumulate through these investments, but they don't have very much distributions initially to offset it. So you end up having this big bucket of loss that, as your deals sell, can eat away, the gains from those deals can eat away at that loss. Now, there is something called depreciation recapture, right? Because the depreciation, and I'm not an expert on this, but depreciation, some things are 5-year depreciation, some are 37 and a half. It's all kind of different numbers. But if you sell the deal before the depreciation time is done, which in 5 years you're definitely going to, then you took credit for the depreciation all the way down the line, because bonus depreciation, what it does is it accelerates it all into year 1. That's the benefit, right? Mm-hmm. So when you sell that asset, you have to recapture, but not all of it, because some of it will have depreciated, right? So you don't have to recapture that. But if you take your capital that you got, the gain that you got, and invested in a new deal, that will also offset the recapture. And that's why we call it, the golden hamster wheel. And again, it is not an exact science. You can't necessarily know exactly how you're going to offset. But as I've done this for a number of years, I generally have more loss than I do gain. And so I generally pay very little, if any, tax on these real estate transactions.
Yeah, thanks for clarifying that. And just a disclaimer, Jim and I are not CPAs, so definitely talk to your CPA before,
absolutely,
just double check everything with them. But this is a great strategy, right? And this is why we invest in syndication. So which is huge. I mean, if you're doubling your money, right, in 4 to 5 years, or 5 to 7 years, or whatever that is, and you're paying little to no taxes, I mean, that's huge, right?
It is. Well, tax is the biggest eroder of wealth, right? That is the number one thing that takes money out of your pocket, is taxes. So if you can stop paying taxes, again, legally, then you're going to be way ahead, even if your returns aren't beating what maybe other people are getting in the stock market or whatever, which they probably are. But let's say for now that they aren't, you're going to beat them in the net because you're not paying taxes, and those investing in Wall Street definitely are.
Yeah. Yeah, absolutely. Well, and you have a good year on your W-2, it's like, okay, yeah, I grossed this, but 30% of that, or if not more, depending on your tax bracket, is going right to, the IRS, right? And
yes, it is.
And so I think that's a good segue into, let's talk about the snowball effect, right? And the compounding, that kind of some exciting numbers, to what syndications can actually do when you do invest. Say you just invest, maybe, let's use the example of a $50,000 per year, right, for each syndication. Walk us through that, Jim, and just how that could compound.
Yeah, it's really, you start with a small snowball, right? And you invest $50,000, and maybe they have an 8% pref, and so they're paying you $333.33 a month. And you're like, okay, great. I can, that's part of my car payment or right, whatever. It's not that much, and I just gave somebody 50 grand. But, this isn't a get rich quick scheme, right? This is a grow wealth slowly scheme. Mm-hmm. And you will be shocked that $333, okay, so let's say you do 50 grand again the next year. Now you're at 667. and you do another 50 grand the next year. Now you have $1,000 a month coming in, right? And you keep going, and eventually that first deal you did is going to go full cycle. Whether, 2 years ago, we would have said it'd go full cycle in 3 years or even 18 months.
Yeah.
Now, 5, 7, 10 years, right? So it's a slower process. But still, when that thing goes full cycle, and let's say in 7 years it doubles, well, now you have 100 grand that you can invest. And instead of that investment giving you $333, is going to give you $667. So each time it just compounds and compounds, and it is the snowball that just grows. And after, 5 years of doing this, you're going to be shocked at how much of your expenses you can handle just with these passive investments. Now, these are long-term illiquid investments, and you mentioned, distribution stopping. So you have to be prepared for that. You can't go all in and burn the boats on this because, it is very volatile. But if you just have a steady approach and just build as you go, you can replace a lot of your income and eventually all of it.
Yeah. Well, and I think that's a good point you hit on too, I think it's really important, when you're sitting down and determining your goals and really what you're looking to achieve in the future is, are you a cash flow investor or are you a growth investor, right? Because like Jim mentioned, these are illiquid investments. So if you need that money in 3 years and it's a 5 to 7 year hold period, you can't just go to the operator and say, hey, I want my money back, right? It just doesn't work that way. So you definitely got to make sure you have access to funds. But and like me right now, I'm a growth investor, right? I'm just looking to build my net worth and just experience that compounding effect or the snowball effect. I like that actually analogy better. And in 5 years, 5 to 10 years, I mean, how exciting is it to be able to replace maybe my wife's income, right? Or maybe all my expenses, and I'm just living off passive income. I mean, that's the goal here, is just to have more freedom, right?
Yeah.
And just to buy back time, and if you're doing something that you love, keep doing your W-2. It's just nice to have that option, right?
Yeah. And that's the thing, multiple income streams is key, because if you and your wife are both just working a W-2, that's 2 income streams. So if one of you loses your job, now half of your income streams are gone. Or if somebody gets sick or somebody gets bored or whatever, right? Well, now I'm a passive investor. Let's say I'm in 30 different investments. I have 30 income streams. So if I lose 1 or 2 of those, or 1 or 2 or 3 or 4 of those stop paying distributions, I'm okay because I have 26 other income streams, right? And so part of this is about building multiple income streams so that no matter what happens in the economy, no matter what happens with your jobs, you're okay. And it's about replacing your income. So you can, as you said, if you like your job, your W-2, stick with it. But if you don't, this is a way out. Or you can reduce your hours. It does give you freedom. There's just unlimited options when you have other sources of income, and you're not just requiring or not just relying on trading time for money, right? Where you just face time and they pay you, but you can have other options if you have multiple income streams. So I think that's very important.
Yeah, absolutely. Well, and just planning, you got a backup plan too, right? I mean, I'm in, my career is sales, right? I'm 100% commission in what I do. And it's really great when I'm healthy, I'm able to show up. I got, the economy's good, but when say the economy's bad, or say I get hurt and I'm not able to go out and perform, right? I mean, that looks a lot different. So
absolutely.
Yeah, it's definitely just a backup plan, and just again, a great way to grow wealth. And I think, to that point, so we use the example of $50,000, right? And not everybody has just 50,000 laying around, especially just getting started out in this space. So Jim, if you would, talk a little bit about, TriVest, how that works, just group investing, because I think that's a great way to get started, just to get experience to some of these deals with, again, not having to have a lot of capital in the bank.
Yeah. And you're exactly right. I mean, it's hard to generate 50 grand or have 50 grand extra. And, when you look at it, a lot of people have their 401k, and over over a year, they might put $25,000 or $50,000 in their 401k. So it is possible to save that up, but it's a big chunk, right? So if you're just starting out and you also just want to dip your toe in, and maybe you just want to try this out, but you're not ready. Maybe you have 50 grand sitting in the bank, but you're not ready to put it all in on one deal. TribeVest is just a platform. It's just a company that helps people invest in a group, right? So let's say you have 5 buddies and you're all getting all excited about this passive investing stuff, and each one of you has 50 grand to invest. Well, separately, you're going to invest in one deal each, right? But if you group all your money together, now if there's 5 of you, you can get into 5 deals, right? So you can have 5 different asset classes, 5 different sponsors. So now you're diversifying. You're putting 10 grand in each deal. So if one goes south, you're still okay. And that's what TribeVest helps people do, is they provide the platform so that you can get your group together. They'll do the LLC, they'll create the bank account, and then there's a platform where every decision you can vote on, and you can see all your investments. You can manage everything in their portal. It's just so easy, right? I know how to create an LLC and get a business bank account, but I still use TribeVest because it's just easier to have them do all that work, and all I have to do is go find the investments. So there's lots of ways to do a tribe. You can do it with people you know. There's tribes that have started through Left Field Investors with people that didn't know each other and just got together. But it's not just for inexperienced people. It's for experienced people as well, because what you do is you effectively create your own mastermind, right? Because if you and I are in a tribe together, and Jared, you bring me a deal, I'm not just going to say, oh, yeah, great, Jared, let's invest in it. I'm going to ask you questions. I'm going to make you present the deal to me and tell me why it's worth investing in. And so what happens then? You get better at investing because you have to learn to defend your position, to say why this is a great deal. And so you're going to prepare more, right? Probably to present it to the group than you would if you're going to invest in it on your own. How crazy is that? And then I'm going to ask questions. So we're all learning and we end up being better investors. So there's just a ton of different ways to do tribes. It's also a great way. A lot of investments or syndications, they might have special terms they'll give you if you invest 500 grand. Well, I'm not investing 500 grand in any one syndication, but if I get my community together and we get 20 people and we invest 500 grand together, then all of us get these better terms. So there's a lot of different ways to use TribeVest effectively to just kind of help your wealth grow.
Yeah. No, and I'll tell you, just to go off what Jim said, it's an awesome resource. I know I'm actually a part of a tribe. And one thing that we did when we were just probably 10 or 12 of us got together, and we kind of determined what asset class, what we wanted to focus on, and we narrowed it down to 3. So each of us, went and we vetted an operator. So, and then we brought that back to the group, right? And just gave a little 5-minute overview of what this operator, and people were able to ask questions. And it's so interesting because even if, you have a good understanding, I was invested in 6 syndications prior to that, or 5 or something. And so I had a good understanding of how it worked, but it's interesting just to hear other viewpoints, the questions they ask, kind of their vetting process. So there's a lot of education and resources just within that group. Even we had people that were just starting out, one guy had 15 plus, passive investments, right? So it was a cool way to learn from each other and just go through that. And I love TribeVest. It just does everything for you, right? You just, I'm the same way.
It's a great platform.
It really is. Jim, if you don't mind me sharing, you're in a ton of syndications. I think over 100 or so plus, right? Probably a lot of those are through the tribe. Platforms as well, but you just have a ton of experience and you're taking the time to share that with others. And Left Field, I've watched that grow, because in 2020, I would probably, it was probably late 2020, maybe early 2021 when you started kicking off the podcast. I mean, there was nothing to do, it was exercising, going out on runs, and I just put the LFI in my ear and I just learned about passive investing, right? And it's a good way if guys like, if you're like me who just geek out on this stuff, and your wife's just like, oh my gosh, just go somewhere, get away, stop talking to me about this stuff. Go to a
Right.
community like LFI. Like we love this. I love talking about investing, the future, the wealth you can create there, and just working together with others has just been awesome. So again, just wanted to say thank you for that.
Yeah, well, I appreciate that, and it is a team sport. If you walk outside your front door, I've said this before, and you talk to your neighbor or friends about finance, they're going to be talking 401k, IRA, your interest rate on your mortgage, and Jared, you're going to be saying, well, wait, what about syndications? And just blank stares, right? They're all going to think you're nuts, and that's why a community like Left Field Investors or whatever community you have is just so helpful in this way, and we all kind of it's just such a collaborative group, not only the LPs, but the syndicators too. They're all willing to help and train people and educate people. And it's just part of the way, that's how you build wealth, is by educating others. You become more educated.
Yeah, absolutely. Well, and you got tons of events. They're doing in-person events now. So especially if you're in Columbus, Ohio, I think y'all do some local stuff there, but they're at meetups, conferences, or nationwide. So definitely go check that out. And it got some great partners too. I know like Pfizer, if you need some resources to help manage all your portfolio and investments, they do all that. And I think you partnered with Richard Wilson too, right? In the family office.
Yeah.
There.
Yeah, we go to a couple of the family office events every year, and we're super excited about that. And we're also super excited this year. The Best Ever Conference is the biggest, syndication LP operator kind of conference. And we're actually, Left Field Investors is having a full day. We're opening the BEC with a limited partner education. So we're going to have all kinds of people coming in and talking about passive investing to LP investors. So we're super excited about that. It's in Salt Lake City in April.
Awesome. Yeah, definitely encourage y'all to check that out if you're able to get out to Salt Lake. And that's you said April, Jim?
Yeah, April 9th through the 12th. It's a really great conference. And if you go through Left Field Investors, you can get the highest discounted price that they have available. So I'd highly recommend people check it out. You can go to our website for full information, or go to the Best Ever website as well.
Perfect. All right. Yeah, I'll make sure to put that in the show notes as well. And then just curious, do you have anything coming up in Phoenix this year that y'all are aware of?
We might, last year we did kind of just a Q&A. We met with Rise 48 there, and Zach and I kind of had a meeting, and my parents are out there, so I do well, they're in Tucson, but I go to Phoenix every once in a while, so I'm hoping to get out there again at some point this year. Just haven't figured it out yet.
Okay, cool. Well, let me know. We'll have to connect when you're out this way. So
yeah, definitely.
Yeah, I know I wanted to get to that Rise event. I wasn't able to make it that day, but definitely looking forward to something here in the future. We are now going to go into our fire round. Jim, I'm going to ask you 4 questions, with the first one being, if you could recommend a book on real estate for investors just starting out, and then another book that is particularly good for cultivating a positive mindset.
Yeah, I got, I'll start with A Hands-Off Investor by Brian Burke. Yeah. Now, that's a great book. It's for those starting out and for experience. When I first read it, I made 17 pages of notes and just went through it all the way, and it's just so helpful. Highly recommended. That was always my go-to recommendation. The one for mindset, I will say this one is not just for mindset, it's also for real estate investors, passive investors, and it's written by one of the founders of Left Field Investors, Steve Sue. It's called Avoiding Rookie Errors as a Left Field Investor. And it is, and I know I'm biased, so please excuse that, but it is the best book I've read on passive investing, not just for how to invest and how to avoid these errors, but also it's a mindset book, because what Steve does is he's been doing this for 14 years, and he takes 20 mistakes that he made and just talks through them. And I've read that book a couple of times, and every time I learn something new. And it's great for beginners because they can take the shortcut, right? They don't have to make the same mistakes that Steve and others like him, like me, that we made. And when I read it, as a more experienced investor, I still find things that, oh yeah, I got to make sure I'm doing this. So it's a phenomenal, phenomenal book. And again, I know it's written by, one of the founders, so I am biased, but it's got great reviews on Amazon. So I highly recommend Avoiding Rookie Errors as a Left Field Investor.
Yeah, no, thank you for that, Jim. And I'll have to check that out. Now, if you're watching on video, I believe it's that book right there in the background too, right? Is that it?
Oh yeah.
Awesome.
Yep, there it is.
All right.
It's really a great book.
Yeah.
And it's an easy read. It's not super long.
Okay, cool. Yeah, we'll definitely have to check that out. And it's just learn from other people's mistakes, right?
Absolutely.
And Steve's, took the time to share that in a book. So yeah, I definitely know I'll be checking it out for sure. And it's good to hear new literature too. You hear a lot of the kind of the go-tos, but yeah, it's good to hear from actual investors who are just focused on primarily passive investing and what that experience is, right?
Definitely.
So, all right, next question here. What is the practical first step that the audience can take to explore the space of passive investing? I think we already kind of answered this, but
yeah, I was going to say,
touch. Yeah.
Read the book.
Yeah.
But, one thing I'd like to add to that is really learn patience, because I think we've been so conditioned to think that deals are going to go full cycle in 18 months or 3 years, and they're just not anymore. And we're conditioned to think that distributions are always going to be paid. And, the author of Hands-Off Investor, Brian Burke, very experienced operator, one of the things he said, and it's true, is that distributions were not meant to be the same amount paid every month, month after month, or quarter after quarter. They're supposed to be distributions of profit, right? Of cash flow from the business. And those go up and down, right? Some months are better than others. So, we can't just depend that this is going to be every month the same payment, even though we have preferred returns and all that. It's just having patience and understanding that if an operator stops distributions, I don't like it, but let's find out why. Are they doing it because they're trying to avoid doing a capital call later? Well, if they are, great, please hold the distributions, because I don't want to give you more money. Give me the distributions later after you've repaired the issue. So I think just patience is something to really think about.
I know for myself, when I started getting into it, I mean, I probably did, I had some capital, but I probably did 6 syndications within a matter of 18 months, right?
Mm-hmm.
And it was almost, looking back at it, right? I mean, I love the operator, the assets I invested in and all that. But looking back at it, some of it was almost fear, right? Fear of missing out on some of these opportunities, which goes back to patience. If I would have just had some patience, kind of just watched, and I think you've even said this before, is just invest in one operator, give it a year, see how that goes, right? And it's all hindsight, but looking back, I would have wish I had more patience, just kind of going into that. And, but you don't know what you know. And that's why, like, Steve wrote a book on it too, right? You learn
That's right.
You learn from other people a little bit further ahead of you. All right. So next, third question here. Next question is, what is a daily habit you practice keeping you on track towards your goals?
I walk every day. Every morning, it's the first thing I do when I get up is I go for a long walk. I listen to a podcast. I listen to a bunch of them actually. And I always pick some that are going to educate me and some that are going to entertain me. And that's just a great way to start my day and get going with a little bit of blood flowing, a little bit of education, and a little bit of entertainment.
Awesome. What are 2 of your favorite podcasts that you typically listen to?
Well, one that I really like now is Drunk Real Estate. It's just a 4 guys, Jay Scott, Mauricio Rual, and a few others, and really good guys. And they're talking about just real estate. They're in the syndication space, and they're not drunk. They're having a drink, and sometimes it gets a little silly at the end when they get to the bottom of their glass. But that's a really great one that I like to listen to. And I also like Invest Like a Billionaire. And that's another one from Ben and Bob Fraser from Aspen Funds. It's a really good podcast. They get some great guests.
Perfect. Yeah. I've been hearing a lot actually about both of those. So yeah, I need to check those out as well. Well, cool. And then so last and final question. If you could be remembered for one thing, what would that be?
I think it would just be trying to be authentic, right? And trying to share and help others. And, not totally there yet. That's the goal, but just to be able to present yourself and be there to kind of help others improve in whatever way they are. For me, it's kind of helping people build wealth, not just for the money, but for the, as you said earlier, for the freedom, right? Money doesn't buy happiness, but it can definitely give you freedom. And that allows you to do the things that you want to do the things that are important to you. So I think that's what I'd like to do.
No, that's awesome, Jim. And I can just say based on your answer there is, one of the reasons that kind of drew me to left field in your podcast is because you were authentic, right? It just really seemed like even on a podcast, you were trying to learn and you were asking questions that a passive investor would ask, and you're not trying to just sugarcoat it or, some of the questions you put these operators in kind of they're difficult answers, right? But it's like, hey, this is what I want to know. And so I think you've been doing a great job of that. And of course, the community and giving back. I know you didn't intend to left field to be where it's at today, but you started that just kind of wanting to just help another, investor, just help somebody that, wasn't as further, wasn't down the path you were quite yet. And look where it's become, right? Look at the community you've built.
No, it's crazy. Yeah. We never expected it, and started it kind of selfishly to educate myself, and now we're end up educating myself and a bunch of others. So it's really been a nice ride.
Awesome. Well, if you could, Jim, I'm sure they probably know already, but if you could just tell listeners where they can find you if they want to connect or check out LFI.
Yeah, you can go to our website, leftfieldinvestors.com. There's a button there if you want to connect with us. That's a great way to do it. There's lots of content there. We do have a free part of the website, and then we have a paid membership part. So explore around. If you have any questions, my email address is jim@leftfieldinvestors.com, and happy to exchange emails or get on the phone and chat with someone who has questions.
Yeah. And I'll tell you guys, it's a membership of like $199 a year. It's very inexpensive for the resources you get in that community. So I highly encourage y'all to check that out. And if you like the show, please share it with a friend. Again, just kind of what Jim and I were talking about this community. Share it with someone that doesn't maybe know about this space or just learning to educate themselves. And if you got some value at it, please give us a 5-star review. It helps us. And yeah, Jim, again, thanks for, taking the time to be with us today. And hopefully we'll catch up in Phoenix when you're out this way.
That sounds great. Thanks for having me, Jared.
Awesome. Thank you for listening to the Optimal Wealth Podcast. If you enjoyed this episode, please be sure to rate, review, subscribe, and pay it forward by sharing with a friend. Most importantly, be sure to optimize your results and take massive action on what you have learned here today. For more, visit optimalequitygroup.com.